The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hey, thanks. Welcome back to the program. I'm your host, Peter Weitz, and this is the In Black and Weitz radio show. Great show we had last week on Social Security, or what I termed social insecurity, and I really appreciate all the feedback and the emails that we got. Our guest was certainly more than welcome to pass along his advice. I got a really interesting show coming up in a couple of minutes, and you're going to really like today's guest. But real quick, I want to thank our sponsors, the law firm of Retzel and Andrus, Stephen Douglas and Associates, and American Century Investments. If you have any questions or you want to speak to our guest today, feel free to email me at peter@inblackandweitz.com, or you can follow me on my blog at inblackandweitz.com. I'll also be tweeting with my handle at Peter Weitz some of the salient points that our guest makes throughout the show. And feel free to join my network on LinkedIn at peter.weitz. So without further ado, I want to jump into the program because it's going to be a pretty lengthy discussion today, and it's going to be on franchising. And I think we all understand what a franchise is for the most part, but we're going to hear some really interesting points as they relate to what's going on in corporate America and some of the nuances that are happening in the marketplace as we speak today. My guest is Anthony Calamunci, and he's a partner in the Toledo office of the law firm of Retzel and Andrus. He practices specifically in franchise law and franchise litigation, but he also focuses on distribution, licensing, and supply chain law. He's counseled to a number of U.S. companies and some foreign companies, and they include both regional and national franchises. I think it's interesting. We'll talk about he's the founder of the Franchise Rescue Team, comprised of top franchise executives focused on creating strategic solutions for underperforming franchises. He's a frequent writer and speaker on both domestic and international distribution, licensing, and franchise law. He's a native of New York, a college football player, and we're talking a graduate of a very small law school in Ohio. But I'd like to welcome to our show Anthony Calamunci. Good morning, Anthony.
Good morning, Peter.
And I appreciate you being on the show. As I mentioned to our listeners, I want to get into a pretty lengthy discussion today on franchising, but I kind of think we should frame out what the industry really is before we get into any kind of discussion in that regard. So give me a brief overview of the industry size and its scope within the marketplace.
Oh, that's great, Peter. I mean, I think what we have to talk about really is people think of franchise and they always think of McDonald's or the food segment, Subway, and what the big chains are. The reality is franchising is an industry that's an industry regulated for the purpose of selling business opportunities. That's what a franchise is. A franchisor is in the business of selling a business opportunity to a franchisee that will use their trademark, their rules, their specifications, and implement a business plan. So, to broaden the spectrum of the food space, which I think most people place it in, obviously it's in hospitality and it's in professional services and a whole spectrum of automotive, in other retail segments. And I just think generally we have to think broader. So when we talk about kind of an industry depth, we should look at a lot of the different segments within the industry and not just food that I think most people think of, which, by the way, QSR food, quick service restaurant category is the largest category. But we need to look at it more broadly.
And so when we're talking about franchising today on this program, we're going to speak more from the corporate side, I assume, than opposed from the individual side. Is that correct?
That's correct. More of a corporate perspective of kind of where it's at. and how impactful it quite frankly is on our economy, on our U.S. jobs, on the industry. For example, the IFA, the International Franchise Association, publishes something called the Franchise Business Index, the FBI. And the FBI is a publication that forecasts where the industry is going, and it categorizes things like numbers of establishments. So, for example, we have over 780,000 franchise establishments in the country. So when you start thinking of those kind of numbers, they become astonishing. And by employment, we have over 8 million, almost 9 million people employed in the franchising industry. And outputs as a percentage of gross domestic product, it's 4.5%, $493 billion. So you've got just some overviews to say anyone that's in a business is either doing business in the franchise industry or touching it in some way. They may not know it, whether it be through distribution, retail, or professional services.
Okay, so I come up with an idea. I decide to make something, or it's a sandwich, or it's food, or it's, a new hotel brand or something along those lines, and I want to grow. And I'm not so sure that I have the capital to just support all the growth myself, and I decide I want a franchise. How do I decide how big to grow, how much to charge, what to do? Can you walk me through that?
Absolutely, Peter. I mean, that's a process that starts with, because it's a regulated industry, you get your lawyers involved. Because it's an industry that's driven by unit level economics, the first question I'd ask you about your idea is it an idea that's validated? Is there a history of unit level economics that would drive your company? We've got 3 operating units. They're profiting at X number of dollars. And we think through duplication, we can scale this brand to 10, 15, or 100 units. And we want to build a legal plan and a business plan, and as you say, a capital plan to accomplish those goals. So it's kind of a process of legal and finance and accounting and working with the executive team to build a ramp up or a scale up plan.
And you put together this plan, and then what happens? I mean, what kind of documents are required? What kind of information do you need from, the idea maker of this franchise?
Well, what happens is the Federal Trade Commission regulates the franchise industry. It doesn't police it, it regulates it, is what I tell people. It requires that there be a disclosure document, not unlike an SEC disclosure document, and it's got 23 parts, and it says this is specifically if you want to sell a business opportunity, particularly in the registration states that require that the document be registered in that state. There's been some confusion from time to time where franchisors think they have to register the document with the Federal Trade Commission. The document actually gets registered in the registration states that require it. States like California, New York, Maryland, Michigan, Minnesota, there's a whole list, 15 states that require registration. So when you record, you put your document together, and it includes all those things you would imagine would be in the document, which includes, all the franchise agreements, but it describes in particular the offering itself. What is this business opportunity that the franchisor is offering to the franchisee? And when you delineate that, that derives from the business. So in the finance team and the accounting team and the legal team and the business team work towards a comprehensive business model. The document, the disclosure document, is going to replicate that. It's going to be what is it we're offering to sell, and how are you going to make money? So there's financial disclosures and the like, and things like that would be required.
Those documents get filed, and then the franchising begins. So I suppose you divide, let's say, the United States up into some logical territory and start selling off franchises. And how does the economics then work from the corporate side, from the franchise or?
This is always the challenge, and it's scale. It's how much of an infrastructure do I need as a franchisor? And this is segment specific and industry specific. But if I'm in the food industry and I want to go from 10 restaurants to 20 restaurants, how much training and support do I need? Because that's one of the things you're pledging as offering this business opportunity. You're coveting to people you can provide that support. And so one of the big challenges is how do I, and we look at historical companies who have done it right, to say how many restaurants do I need and how many regional supervisors, how many training people, how many franchise salespeople do I need, and always recognizing that scale is important. So when you say let's start selling franchises across the country, for example, there's a client that I'm working with in the Northeast right now that is going to develop a Northeast development plan because they recognize with their capital structure that they don't want the challenges of going beyond the Northeast region to provide the support. So you got geographical and cost restrictions and barriers if you expand your geographical scope too far. So to your point, do you start selling all over the country? Maybe you do. Maybe because of the type of franchise, it's not infrastructure or capital intensive, but for the most part, most franchise companies try to validate within a particular market and or region and then grow the brand from there.
Yeah, that's interesting. So obviously growth too fast could be a detriment to a franchisor.
Absolutely. You know, and I think it's been said many times that, you know, building a business or opening a business is easy. Building a brand is very challenging. So it's, you know, identifying what that brand is and that logo in a particular, that trademark within a particular trade market is the challenge that a franchisor has, because you better validate you're giving value. I mean, the Federal Trade Commission says that you really have if you have three things, you have a franchise. You've got a trademark, you're charging something for it, and that you've got this ongoing relationship, and if you've got these things, you've got really what is deemed to be a franchise that's a requirement going forward. So if you have the required payment and you put significant controls on how someone uses your trademark, the FTC is probably going to say you're a franchise company. So what are you really offering to that franchisee? And I think that's where the depth of the franchise company comes. So if you have a regional growth plan and you can show that there is a market identity to your trademark, you're giving much better value and much more validity to the concept itself.
And so it almost sounds like that if I'm going to purchase a franchise or franchise rights, I'm almost buying the trademark, it seems, or the value of that trademark, because that's really where I'm going to get some bang for the buck.
Yeah, one of the questions that we field all the time is what's the difference between a license and a franchise, right? A franchise is a license, but it's a controlled license, because if you are putting particular, it really gets down to how much control are you putting on the individual to whom you have licensed the right to use that trademark. And if you have put restrictions and controls and specifications on the use of that trademark, and we could spend 2 hours of the show talking as to why you'd want to do that, right? But all those controls and mechanisms you put in place to preserve the integrity of that trademark are also those same controls that make you a franchise, make you now part of this regulated industry. And the example would be if I just said that, you know, we're going to open up Joe's Tacos tomorrow, and I don't care, you just like this shiny logo, and all you have to do is go do whatever you want to do with it, I might just license that because I'm not telling them what to do. But the minute I tell them that the specifications are an 1,800 square foot store, and you've got to have this POS system, and this is what the wrapper is going to look like, and this is what the product specifications, and this is where you must buy your food, and this is the preferred distributor, and here are the signs and disclosed product specifications. I've now put a lot of controls on the use of Joe's Tacos logo and trademark. And now I'm a franchise. Now I'm part of a regulated industry. And there's a whole lot of examples that fall someplace in between. Where are you, you know, a license? But the reality is, just so it's clear, a franchise is a type of licensing relationship.
And that's interesting. When we come back from the break, we're going to get into sort of the what's going on in the private equity and the brand consolidation sector of this market. You're listening to the In Black and Weitz radio program on Voice America Business.
When it comes to business, you'll find the experts here. Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hey, thanks. Welcome back to the show. I'm your host, Peter Weitz. We're joined today by Tony Calamunci, an expert franchise lawyer with the law firm Retzel & Andrus. And we spent the first segment of the show talking about sort of how franchises evolve. I want to spend a little bit of the show talking about where the industry is at the moment, particularly in the private equity world and in brand consolidation. So during the break, Tony and I were talking a little bit about McDonald's and Chipotle and how, they interact with one another and how they're segmented, but yet they're owned by the same company. And then we spoke a little bit about a couple of the private equity firms, some of the larger ones, and some of their holdings and how they're structured. So, Tony, I'm wondering if you could walk our listeners through the structure of a private equity firm and the benefits of a private equity firm owning a big franchise name.
Well, I mean, it really does get down to an issue of scale. As to the particular different platform, companies that are involved, I mean, some of the big ones, obviously, Rourke Capital Group, Sun Capital, Catterton, these are all companies that own multiple franchise. They've got into the space and they've invested in platform companies. And they all have their own unique way of approaching that, because obviously with the opportunity to utilize and maximize and leverage high-level executive talent that has rendered success. You mentioned Chipotle and McDonald's. Those are 2 very highly successful companies that would benefit from high-level executive talent. However, the pattern in private equity has been to pretty much silo off the companies and allow them to be run by their individual presidents. However, when things are working in one of the particular platforms, they'll apply that across the board or apply that into other brands where it makes sense. So there's a lot of value in utilizing private equity. One of the other benefits that happen from time to time in platform franchising, particularly in the restaurant segment, was that when one particular concept wasn't working and it was in a similar footprint in maybe a different segment, maybe it was, a smoothie concept versus a sub concept, they would have a conversion plan in place. So when they would have an opportunity where franchisees could maybe own multiple franchise within that platform. So it allows you to scale up and really grow your brand with successful franchisees that are multi-unit operators in one of your other brand platforms, offering that franchisee growth in one of your other platform brands. So you're not necessarily competing with yourself that way. So there's a lot of benefits to private equity. I think private equity has been good for franchising in a lot of ways, and there are some people that hesitate. But I think ultimately private equity has provided a lot of solutions and scalability to brands that otherwise wouldn't grow and have the capital to grow.
Right. So are you suggesting that if I'm a startup franchisor, I've got a small number of units, as opposed to just dividing up the country, as we spoke about earlier, into segments, selling off the rights, I could essentially bring my business to a private equity firm, and they could control and build my growth for me?
Well, first of all, it would be a rare exception that private equity would get involved in any. That would almost be a pre-revenue model because you don't have validated stores. The term validation means different things to different people. They look at things like system-wide sales, unit-level economics. Where is the segment trending in the right direction? So is it an area that they want to get involved in? Does it provide them particular segmentation within their platform? Does it provide them depth in their platform, their portfolio platform? So all these things are things that private equity would be looking at before they would invest into your particular concept. But assuming in the hypothetical you have 100 units open, and those 100 units are performing at a predictable unit level performance, and you've established after operating 100 restaurants that you can multiply and validate that your team can manage multiple units, that you had a growth and capital structure that made sense. All those things play into a growth model, and now private equity comes. Can we turn this 100-store chain into a 1,000-store chain, and how much capital and how much ramp up and scale do we need to get us there? And that's probably more where private equity comes in and gives that infusion of capital, where they've got what they're going to call a defined validation of the brand.
And so it sounds like there's some critical point where private equity can sort of take over and run with the ball. And there's some unit, some number of units, whatever that is.
Absolutely. I mean, and it varies by segment. I mean, healthcare is a big segment in franchising right now. And I've heard that, some people believe that validation, perhaps in the healthcare space, might not be at the same unit level number as the restaurant space. But I think it really becomes critical to what is the private equity company looking for and how are they defining validation. I would suggest that, that's going to vary, but you're right. There's going to be some critical number in the metrics that say this is what we're looking for. We're looking for this much in system-wide sales. We're looking at this unit-level performance. We're also looking at a growing market. Maybe we don't want to be in burgers and we don't want to be in pizza. They're saturated markets, but we'll look at a market that's going to grow. Maybe the smoothie market has some caps that we can grow in. So these are the types of decisions that are made in boardrooms. There is brand consolidation right now, and I think that the brand consolidation really marries up with where the market is. And the brand consolidation that we're seeing is that these platforms become interesting to offer, again, for scaling your franchise system, offering, a sub opportunity, maybe a Mexican, maybe a pizza, maybe a burger in your platform, maybe an ice cream platform. So they try to diversify these platforms, so they'll consolidate into brand platforms.
And so is that like kind of like Kentucky Fried Chicken, Taco Bell expanding? I mean, is that what you're saying by brand consolidation? Or
Yum Brand is the best example. You'll go by those what I would call the co-branding stores, where you'll see a Long John Silver's on one side and a Dunkin' Donuts on the other, or you'll see the Taco Bell on one side or the Pizza Hut on the other. So, they did a really good job saying, we're going to co-brand and basically divide up day parts to maximize the occupancy cost for the rental space. So that's one of the other benefits of having a platform where you can plug in different brands, is looking at the occupancy cost and trying to maximize the day parts. And the day parts obviously are the numbers of times you're going to have your customers frequenting the establishment.
But and also in this term brand consolidation, when I think of the term, I think of one company buying another. Are you seeing a lot of competitors buying competitors out?
There are some segments that's happening in, and I think that, you see it. It's not trending right now. I think that, you're never going to see, the McDonald's buy the Burger King on that scale. I think you've seen some brand consolidation on some of the gym concepts. I think you've seen it in some of the smoothie concepts, and there's a lot of activity in the frozen yogurt across the board right now. But you are seeing some of that happen where somebody may have already developed the market, but they're undercapitalized, so someone will come in and buy out a brand. But not a lot of activity in that regard right now.
Interesting. And when we come back from the break, we're going to talk about restructuring debt and how the real estate's impacting, the cost of real estate and the cost of capital is impacting the success of franchisors around the country. You're listening to the In Black and Weitz radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. We're joined today by franchise law expert Mr. Calamunci from Retzel and Andrus, one of our sponsors, Tony Calamunci. And anyway, we were talking before the break about what's going on in the industry, and we actually got an email at the break. And the email comes, the question basically says, what's going on with Wendy's? I see that they're changing the look and style of their restaurants. Can you explain the dynamic of that?
Well, Wendy's is going through some rebranding. I'm familiar with that. We're working with some of the capital partners that are actually approaching franchisees to restructure current lease obligations and real estate ownership because of the capital markets and the interest rates stabilizing, and because of the cost of real estate stabilizing after the Great Recession. We see a great opportunity for restructuring. So you've got occupancy and lease restructuring that's putting money into the franchisee's pocket, allowing them to free up capital for rebranding and rebrand positioning, which is required by the franchisor, and also allows them to better cash flow, therefore increase and improve unit level economics going forward. So that is a trend. Wendy's happens to be a concept that is in a freestanding type space versus an inline space or a food court type space. So it allows them that opportunity to the extent that those franchisees are in those types of settings to go through that restructuring. So I know a number of franchisees in the system are doing that, and I do know that the franchisor is requiring brand repositioning and rebranding and new signage and kind of a new look for the brand.
So what prompts a franchisor to want to rebrand?
Well, for all the reasons that you'd want, I mean, one of the things that you're offering a franchise when you are the franchisor is advertising and marketing. Again, we go right back to what a franchise is, and a franchise is a trademark, and we're putting controls on that trademark, and we're charging a fee for it. And the value of that trademark is all about brand awareness and marketing. So franchisors, I think, are always aware, particularly if they see a dip in the market, if they see unit-level sales or system-wide sales dip, or they see an inordinate amount of store closings in a particular period, that they've got to look at the brand and give the brand a new, fresh look or a fresh start or a renewed look. So the marketing people and the people that are involved in consulting at the franchise level, including franchisees, usually there are advertising consortiums and franchise associations with franchisee participation that come up with plans, and often it'll be rebranding. And I think that it happens from time to time. I think it's necessary, as for all the reasons you can imagine. Brands get stale, and brands need to be refreshed from time to time. So we'll see how successful the rebranding efforts are at Wendy's, and as you see other companies revitalizing the brand or reinitiating the brand, I think there's been a lot of success stories, and there have been some that maybe was a large investment that didn't go very well.
Give me an example. I was just thinking about that because I'm thinking, what if the Wendy's rebranding doesn't work out? What are some examples of franchises that have tried to rebrand that have not worked out?
Well, I think Burger King went through some rebranding, and I'm not so sure it did as well as they expected it to. I think that Arby's has gone through 2 or 3 iterations of rebranding that perhaps didn't do as well, and they almost changed what their concept was. So I think that there have been times where, the franchisees have said, wait a minute, you want me to spend, and these are often 6-figure commitments you're asking your franchisees. And when you combine that with a dip in unit level sales that led to the decision for rebranding, now you're asking for a franchisee to take another investment in the future of a brand, which they're either breaking even or making marginally less than they were. So it becomes a challenge. It becomes a very difficult sell as you move forward.
So what happens?
Yeah.
What happens if the franchisor doesn't have the capital or the money to make these changes?
The franchisee. Well, that's interesting because you hit the nail on the head. One of the dynamics in this industry that are very unique is that the franchisor and the franchisee derive their revenue from the opposite ends of the profit and loss statement. If I'm a franchisor, I get paid out of gross sales. So this has always been a challenge. And the challenge is, hey, we're going to initiate this rebranding effort, and we're projecting that unit level sales is going to bump 5%. But by doing that, that means that our 6% royalty is also going to be increased, 5%. But what does that mean to the bottom line revenue and profitability of the unit. Because maybe if it's a $200,000 investment, a 5% increase makes the store less profitable to the franchisee. But the franchisor has already made their 5% increase at the top. So you can see where it becomes a challenge, right? Not unlike the challenge, there was a famous Burger King case recently, a few years back, with regard to the dollar double cheeseburger, because franchisees were said, you're going to sell this on the dollar menu. They couldn't make money. Franchisees filed a class action lawsuit against Burger King saying, we can't make money on this product. And ultimately, the final adjudicator of the court determined that because it was part of marketing, that the franchisor could dictate price, where for years the franchise couldn't. And now across the board, you see where you have the $5 footlong at Subway and you have the dollar menus and other things, where actually franchise food companies in the QSR and fast casual space are selling price points. It kind of changed the market. And I think that's not unlike these rebranding evaluations. When you look at a franchise company and you tell a franchisee you're going to invest $200,000 and you don't have a capital plan to allow that franchisee to effectually execute on that rebranding and make a profit at the bottom, now the franchisor has a problem. They better have a plan going into the rebranding that allows the franchisee to be profitable, because at the top, they know they're going to make more money. They know that there's going to be a new marketing campaign, and there's going to be rebranding, and top-end sales will probably grow. The question is, do the top-end sales grow to the extent that it allows profitability at the below the line?
Yeah, and I'd imagine that's even more prevalent in the hospitality space.
Absolutely. There's no question about it. It happens all the time.
Yeah, where these improvements just fail and they can't generate enough revenue to justify the cost. I think you and I spoke about that with Holiday Inn.
Right. I mean, if you're a Holiday Inn, can you increase your per night room from $135 to $165 to get the return to the franchisee for a $500,000 investment? I mean, it becomes a measurable analysis for the franchisee to say, well, no, I'm fine right now, because if I go through this rebranding, and the franchisor, again, is focused on their top-end revenue, system-wide sales, they may be preparing for an exit. They may be preparing for, an IPO. They may be preparing for a sale. And system-wide sales may be something they're looking to bump. But you can see where there is a tension between where the franchisor derives revenue and the franchisee. They can't be overlooked when you evaluate any of this, including initiating the franchise business, when you've got to recognize what value do you bring to the franchisee, value defined to what comes at the bottom line.
I think I want to ask one other question, and then I kind of want to switch gears a little bit and talk a little bit about your thoughts of what a franchisee needs to think about, and we'll get to that in a minute. But are there any other trends that you're seeing right now, particularly as we recover, from 2008, that are real prevalent and dominating this industry? Any real estate trends? Any growth, significant growth?
Well, I mean, obviously, there's a lot of growth in healthcare or non-real estate professional franchising. I think that it lessens the capital investment required at the franchisee level, and that becomes kind of an attractive market. So one of the things that I think a lot of people are jumping, I don't know how successful a lot of these companies are going to be because it's such a new market. One of the problems is that there's not healthcare solutions for senior care. And a lot of people have jumped into the franchising space to provide healthcare solutions across the segment space. And
Tony, what's an example of a healthcare franchise?
Well, you've got a number of senior care ones. One we're developing right now happens to be what we're very optimistic about is a dermatology concept that will be providing acne care inside acne centers that will leverage those acne patients out of the dermatology practice and into clinics. So we're excited about that. There are also a number of concepts out there which deal, again, with senior at-home type managed care. So what they would do is everything from going to the home to walk the dog, do the laundry, take care of the medications. And then you've got what I call technology solutions, like, Advantage Home Telehealth that is basically providing kind of a nurse practitioner type, home care solution, for the home, where it's more of a technology based platform where you're licensing, that type of home care, more medical needs, senior care stuff. So I will tell you that that's the market where there's certainly just a lot of activity right now. And it's just too early to know, how they're going to do. Some of the education ones are the same way. But, the ones that kind of stand out at me, are ones that are aimed more at kind of the full gamut of care. So you've got, home helpers and comfort keepers and interim health care and Bright Star and some of these others. And then there's ones like, that really provide, and I think what it's responsive to, which what your question was, is what are they responding to a market? So we're going to have the largest senior population over the next 30 years. And the question is, are we equipped currently to manage it? And I think all the experts agree we're not equipped to manage the senior population that is the next senior population. And so is home care the only logical solution? It makes sense. The question is, what franchise will emerge? I think you're going to see some fail, some consolidate, but ultimately you're going to see a couple of big leaders come out of this segment.
That's interesting. With that, we're going to take a quick break. Tony, when we get back, I want to switch gears and talk a little bit about what a franchisee should be asking before they engage a franchisor and get into business with them. We're going to take a quick break. You're listening to the In Black and Weitz radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. We're joined today by Tony Calamunci, a franchise law expert and a partner at the law firm of Retzel and Andrus. And we've been spending the vast majority of the show talking about trends in franchises around the globe, around the country. I want to spend the last segment switching gears and thinking about it in terms of the franchisee. And Tony, I'm wondering if you could just give me some thoughts on the tough questions that someone wanting to buy a franchise should be thinking about having answered before they entertain taking on a franchise.
You know, obviously a lot of people have different concerns and objectives. I think of it from two components. One is culturally. Once you've decided, I think once somebody gets past the romance of, I want to be in this industry, whether it be a vending business, whether it be a fast casual restaurant, or whether it be a senior home care, whatever it is, you passionately decided you want to be in that business. We talked briefly earlier about the franchise disclosure document, the FDD, the document that the Federal Trade Commission says every person selling a franchise opportunity must have. And that information, there's a lot of information in there. So the first thing I suggest is make sure you get somebody that understands the 23 items that are required to be disclosed in that document and can explain it to you. And that allows you and drives the questions that you would ask. You will know from that document under, item 3 whether the company has been sued and how often that's been sued. You're going to know the business experience under item 2. If they disclose their financials under item 19, you'll know what their financial disclosures are, and you can from that glean what your predictable, a return on investment would be. But I think more than that is if a franchisor brings franchisees to you and says, talk to Jim and talk to Katie, and they're going to tell you what a great franchise company we are, I would say you do your own homework and you go talk to as many franchisees as you can talk to that the franchisor does not point in your direction, and try to get an understanding of culturally who's in the brand, who's succeeding, who's not succeeding. And those are just things that I think at 30,000 feet that even if once you've decided to get into the brand, there's so many, the due diligence process should be more in depth than you were disclosed, you received the disclosure document, you went to a discovery day, you met the salesperson, and you signed the contract. If that's the case, then you've probably done something very wrong.
Oh, answer me this. I mean, what are the most common reasons you see for failure of a franchisee in their diligence and why it doesn't work for them?
Well, I think that, first of all, you forget you're purchasing a business opportunity. So like we said earlier, you're buying a trademark and you're buying a set of rules. You're buying a set of rules that tells you what kind of products to buy. You're buying a set of rules that tell you, what the specifications for the brand, how you're going to market the brand. You're buying all this, but have you ever executed or managed a business in your life? And so often or not, there's a disconnect between, if you're handed a set of rules, that's one thing. Do you have the skill set and ability to execute on that? So I think a lot of businesses just fail because franchisees are not the people that bought that, because just because they have the money and just because they may show good intent doesn't make them qualified to run that business. So one of the things I tell franchisees they should be looking at is what type of franchisee is the franchisor looking for? How selective is this franchise system? And the more selective this franchise system is, the more likely you're going to have like-kind people that think that way in the brand. They're going to help you long-term.
It's interesting. So is that something that's common? Are you seeing a lot of, marketing or interviewing of a particular franchise before they're taken on?
Well, there's no question. There's a process. Each company has its own process. You'll find there are some franchisors that are less selective than others. And I think asking about that will tell you a lot about the culture of the brand. there are certain brands that just have kind of a corporate culture, a corporate vision, and a corporate mission. And if you fit in that culture, you're much more likely to succeed than to fail. So on the franchisor side, when we advise our franchisor clients, one of the things are not just do you buy into a culture of corporate compliance to make sure you are regulatorily compliant. Are you buying into a culture of growing this brand in the right direction? Are you buying into the culture of selectivity? Because who are we going to partner with? Our franchisees are going to take this brand to the next level. So on the flip side of that, if you're a franchisee, look for selectivity. Look for that thing that makes that brand special. No one did it better than Starbucks. When you look at Starbucks, how they grew their company, and talking about just culture and making, their managers owners and making them vested and building a culture of responsibility. It was a brilliant way to build a brand, and I think that's what you need to look at, things like that.
And what about number of units? Is it better if they have the capital to buy more than one, or should they start one at a time? It's market specific. I mean, if the brand has 100 operating units and the evidence shows that the people that opened up 3 stores and you have the capital to open up 3 stores were highly more successful. But operating 3 units, if you have no experience, is a much different task than operating 1 unit. So depending on the depth and experience of the franchisee, the history of unit level success within the brand, you would have to make a business decision as to how do I leverage success into this new company and what is the best track to go on. And so do you find, last question, that a Starbucks as an example where there are corporate owned stores and there are franchises seem to be more successful than just the pure franchise model? Well, I think that you certainly have predictive analytics. You have a track record of this worked and this didn't, that you don't have by just opening up your own store. Open up Joe's Taco is much different than opening up Taco Bell. Taco Bell is going to open up the doors and we're going to know it's going to do X number of dollars the day it opens just because of the brand identity and the systems that I'm buying. For that same reason, it costs a lot more money to open a Taco Bell than it does a Joe's Taco. But the reality is your predictable return on investment is something that can be delineated, that can be identified. So there's a lot of value in buying a franchise. I believe wholeheartedly in the franchise industry, and I think franchisees that do it right buy multiple different brands, and they become what are categorized in the industry as multi-unit operators, which are the big targets. They're the guys and gals that walk around at these franchise conferences and get wined and dined because franchisors love them, and franchisees want to be them because they're the ones that can show and demonstrate and validate that they can diversify and manage multiple brands. Real interesting. Tony, I really can't thank you enough for being on the program. I think it's a fascinating subject. You and I spoke at the break. I mean, there are so many different roads we could have gone down that could create hours and hours of conversation in this regard. But I really appreciate you being on the program. Thank you, Peter, and thank you for your time today. Yeah, my pleasure. And next week, we got a really interesting show. We are going to be speaking with a retirement expert from American Century Investment, and they did a survey of 10,000 elderly people that are 75 years and older. And they asked the question of, if you could go back in time, knowing what you know now, and do what you know now back then, back when you were in your 20s and your 30s, what would you do differently, particularly as it comes to saving for retirement? And people are all across the board. They're going to be young people, old, or wealthy people, indigent people, and so forth that have had different aspects of financial wealth in their lifetime. And they're going to talk about the power of saving and what it really means to you. Thanks again to our guest, Anthony Calamunci, the law partner, franchise law expert at the law firm of Retzel and Andrus. I'd like to thank them as a sponsor and our other sponsors, American Century Investments and Stephen Douglas Associates. We're going to make it a great week, and I appreciate you being on the program. Tony, once again, you're listening to the In Black and Weitz radio show on Voice America Business. See you next week.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.